Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section D. This is an application topic. Calculate impairment losses on long-lived assets to be recognized in the financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. Again, it's free. It is only 1 hour long. And we will teach you the key ingredients to passing the CPA exam. Among them is, again, going to the questions first, studying in the morning, making sure you review what you've studied every day, and things like that. Make sure you go sign up for that webinar. It will definitely be worth it. Also, just letting you know, we will only be going over 5 questions in today's video, whereas Superfast CPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this, if you like the webinar and you want to learn more, make sure you become a Superfast CPA Pro member and you will get access to a whole bunch of awesome resources, again, including the 10-question full versions of these 5-question videos. So make sure you do that. And now with all that said, let's dive straight into the questions. All right, here we are at question 1. Something we always like to point out is reading the last part of the question. It doesn't always help, but it's a really good habit to be in because very frequently this will give you context for the rest of the question so that you know what you're looking for, and that will help a lot in saving time on test day. So let's read the last part here. Based on this information, what is the impairment loss to be recognized, if any? Okay, so we know we're dealing with impairment losses. I mean, of course you know that because you're watching this video, but again, this is a good habit to be in because you're going to see random questions on test day. Central Manufacturing Co. has equipment that originally cost $600,000 and has accumulated depreciation of $240,000. Due to a downturn in the industry, Central Manufacturing Co. suspects the equipment may be impaired. The company estimates that the equipment has a remaining useful life of 5 years, with expected undiscounted future cash flows of $250,000 and a fair value of $180,000. Again, based on all this information, we have to figure out the impairment loss, if there is any, to be recognized. So if you know how to do an impairment loss, that's great. Maybe why are you watching the video? Probably just to get practice. But if you have no idea how to do this, that's okay. We're going to dive straight into the answer because, again, we're using the questions to inform us what we need to know. So let's dive into the answer. All right, here we are. The answer is D, $180,000. So let's go ahead and walk through this and figure out how to calculate that impairment loss. So to calculate an impairment loss, you have to first see if an impairment loss is even necessary. And what you do is you do a test for impairment. What does that mean? You first have to know the carrying amount of the asset, and that's the original cost less any accumulated depreciation. So that in this case was the $600,000 cost less the $240,000 of accumulated depreciation that it already has. So that's $360,000 as the carrying amount. Now, this is something that I want to make sure you don't get confused on. You compare the carrying amount to the future cash flows to know if there is an impairment that is necessary, but that is all you do with the future cash flows. So what does that mean? Let's talk about it right here, and then you'll see what I mean when we go to this next point here. So you have to compare the carrying amount to the expected undiscounted future cash flows. So if they're expecting to make less money than the carrying value of the asset right now, then that means that there's an impairment because the asset has a carrying value that is bigger than the money they're even expecting to get from that asset. So the carrying amount being bigger than the future cash flows means that an impairment is necessary, but you do not subtract the future cash flows from the carrying amount. So don't get confused by that. This is just to see if an impairment is necessary. Now that we know that an impairment is necessary, now we go down here. We calculate the impairment loss by taking the carrying amount and subtracting the fair value of the equipment that they think it should be. So if you scroll up here just a little bit, it said that the fair value is $180,000 now that they've kind of done some thinking and done some researching. They think that the fair value is $180,000. So now let's go back down here. So since they think the fair value should be $180,000 and we know that there should be an impairment because the future cash flows are less than the carrying amount, we bring the carrying amount down to that fair value, and that's what the impairment loss is. We subtract $180,000 from the carrying amount to get down to the fair value that they think there should be. So the impairment loss is $180,000, and the carrying amount after the impairment loss is $180,000 as well in this case. But that's how you do an impairment loss. You have to figure out the carrying amount, then compare the carrying amount to the undiscounted cash flows in the future, and if the carrying amount is bigger than those cash flows, that means that there is an impairment loss that is going to be happening. But the way that you calculate the impairment loss is you take the carrying value and subtract the fair value that they think it should be, rather than subtracting the undiscounted cash flows. So don't get confused by that. And that will give you the impairment loss. So that's how you calculate an impairment loss. Let's go to the next question to see some more things about impairment losses. All right, here we are at question 2. How much of the impairment loss can Summit Co. recover? Okay, so we're talking about impairment loss recovery. Summit Co. purchased machinery for $900,000 and has accumulated depreciation of $360,000. Due to a decline in market conditions, Summit Co. tested the machinery for impairment and estimated the undiscounted future cash flows to be $400,000, with a fair value of $300,000. 6 months later, in the following year, market conditions improved and the fair value of the machinery increased to $450,000. So that's great. It's worth more now. How much of the impairment loss can Summit Co. recover? Okay, so based off what we did before, you could probably figure out the impairment loss in this situation. But can you recover that impairment loss if the fair value goes back up afterwards? If you don't know, that's okay. We're going to dive straight into the answer to figure this one out. All right, and the simple answer is A, 0. No, you cannot recover this impairment loss. But let's talk about it before you start questioning, can you never recover an impairment loss? There are situations where you can, but in this situation you couldn't. So let's read through it. 6 months later, the fair value increased to $450,000. But under US GAAP, once an impairment loss has been recognized for long-lived assets held for use, so if you're still using the asset, you're not planning to get rid of it, then an impairment loss on that asset cannot be recovered. It cannot be reversed if the fair value subsequently increases. The carrying amount remains at the impaired value and no recovery is recognized. So that's the easy answer. In all reality, you didn't even need to calculate the impairment loss. You might not have known that, but in this case, even if there was an impairment loss, which there was, if you calculated it, there's an impairment loss, but they can't recognize any recovery of that impairment loss because this asset is still in use. And by the way, if you ever see a question that is talking about an asset for disposal, which we're about to talk about in the next question, it will tell you that they're thinking of disposing that asset. If it doesn't mention that it's going to be disposed or they're thinking of disposing it, you can probably assume that it's still an asset held for use, meaning that you cannot recover the impairment loss even if the fair value increases in the future. So that's one more rule about impairment losses. Let's go to the next question, like I said, to talk about assets held for disposal and potential recoveries for those impairment losses. All right, here we are at question 3. How much of the impairment loss can Sanders Co. recover? Okay, so again, it's asking if they can recover any of this. Sanders Co. purchased a facility for $1,200,000 and has accumulated depreciation of $500,000. Due to market conditions, Sanders Co. classified the facility as held for disposal and performed an impairment test. At that time, the fair value of the facility was $550,000 with $20,000 in disposal costs. So they're expecting to have to spend $20,000 to get rid of the factory if they want to dispose of it. Sanders Co. recorded an impairment loss. 1 year later, market conditions improved and the fair value of the facility increased to $580,000 with disposal costs remaining the same. How much of the impairment loss can Sanders Co. recover? Okay, so I was just barely talking about how potentially there is a recovery when it comes to assets held for disposal. So think through this, think through what the impairment loss would have been because they did recognize an impairment loss. And then from there, you could probably figure out what the recovery would be if there is one. Hint, there is going to be one because we're talking about assets held for disposal. So I'm just giving you a little hint there. Maybe try this out, see if you can figure out what the impairment loss recovery would be. And when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. The answer is B, $30,000. That's how much they can recover of the impairment loss. So let's walk through this. We have to figure out the impairment loss first to be able to even see if we can do a recovery. So there's the initial impairment test. You always have to do this to see if there's even an impairment. And by the way, I didn't really include this in any question because I feel like it's pretty obvious if the carrying amount is lower than the undiscounted cash flows in the future, then there's not an impairment loss. That's why you do an impairment test, because if the carrying amount is greater than the future cash flows, then there's an impairment. I felt like that kind of goes without saying, but I just want to make sure that's clear. That's how it works. So anyway, that's why you do the initial impairment test. So we figure out the carrying amount, which was the $1,200,000 of the cost, less the $500,000 that they have of accumulated depreciation so far. So the carrying amount was $700,000. Now the fair value less the disposal costs, they're saying the fair value is $550,000. And then there's the $20,000 that they think it's going to cost to be able to dispose of it. So the fair value that they think it should be less the disposal cost is $530,000. So the impairment loss to bring it from $700,000 down to the $530,000 fair value that they think it should be is $170,000. So that is the impairment loss right there. That's what they recorded. They recorded an impairment loss of $170,000 to bring it down to the $530,000 carrying amount. Okay, so 6 months later, the fair value goes back up. Or sorry, 1 year later. 1 year later, the fair value goes back up. The fair value of the facility increased to $580,000. So the fair value went from this $530,000 that they think it was up to the $580,000. And the disposal costs remain at $20,000. So that still stayed the same. Remember, this is for an asset that is being held for disposal. It's not the same as an asset being held for use. The fair value less disposal costs with this new fair value is $580,000 less $20,000, so that's $560,000. So that's what the market says the fair value is now. So they can recover from this $530,000 that it's at right now up to that $560,000 that it could be right now. So that's a $30,000 recovery. That's pretty cool, right? This is one of the few situations where with this impairment, you can go from the impaired carrying value up to the new fair value if the fair value increases for an asset held for disposal. But there is a limit on this. Let's talk about it. There's a limit on the recovery. For assets held for disposal, impairment losses can be recovered, but only up to the original carrying amount before the impairment. If the fair value increased enough, so if it increased to $730,000 instead of $560,000, the full impairment loss can be reversed, but the carrying amount cannot exceed the original $700,000 before impairment. So let me just restate that. If for some reason the fair value went back up and it went back up above or all the way to the carrying value that there was before the impairment, they can recover the impairment loss all the way up to the original carrying value before impairment. So the limit here is they can only recover the impairment loss itself. They can only go back up to the original $700,000. They can't go past it. So, for example, again, if the fair value somehow magically ended up at $730,000 instead of $560,000, they can recover the impairment loss, but they can't recover past the impairment loss because the impairment loss was $170,000, right? So the impairment loss was $170,000 plus $530,000. That gets you back up to the carrying amount. You can't go past that. They can't magically have a $200,000 impairment loss recovery because the impairment loss was only $170,000. I hope that makes sense because, again, basically you can't go past what the original impairment loss was. You can only recover what the impairment loss was. So I hope that makes sense. You can only do this with assets held for disposal, not with assets held for use. So remember that distinction. Now let's go to the next question. All right, here we are at question 4. By how much did accumulated depreciation increase in year 4? Okay, so this is something totally different. We are still talking about property, plant, and equipment, of course, because we're in section D of FAR Area 2. So it makes sense that we're talking about accumulated depreciation, but let's see how that is connected to impairment losses. Northwood Co. purchased machinery for $500,000 with an estimated useful life of 10 years and no salvage value. At the beginning of year 4, the machinery had accumulated depreciation of $150,000. Due to a decline in market conditions, the company tested the machinery for impairment and recognized an impairment loss of $80,000. Northwood Co. continues to depreciate the machinery using the straight line method based on the remaining useful life. So with all that, again, how much did the accumulated depreciation increase in year 4? So if you have no idea how this is going to work together, the impairment loss and the depreciation, that's okay. We can go straight to the answer. But if you have an idea or if you want to try something out, pause the video, do this on your own to kind of see if you can, or at least read through this on your own to kind of make sure you understand what it's asking. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, $118,571 is going to be the increase in accumulated depreciation. That's not what the accumulated depreciation is. That's just the increase to it. So anyway, let's walk through this to see how impairment losses work with all this. This is a key statement right here. When an impairment loss is recognized, so this is kind of thinking about it from the journal entry perspective, it is effectively treated as an increase in accumulated depreciation because basically you're bringing the carrying value of the asset down to what it is supposed to be. Let's go through the steps. First, you of course have to calculate the carrying amount after impairment. So the carrying amount before impairment was the $500,000 cost less the $150,000 of depreciation that they had. So that's the carrying amount before they even think about impairment, $350,000. Now, it did say they recognized an impairment loss of $80,000. It just told us that. So that means, again, if you're thinking about journal entries, that the accumulated depreciation increased by $80,000 because of that impairment loss, meaning that the carrying amount went down to $270,000. So that's the carrying amount right now after the impairment. Now that we've done that, we have to kind of think about what that means for future depreciation. Step 2, we have to calculate the current year's depreciation after impairment. It didn't say that they changed the amount of useful years for the asset. So there's still 7 years left because, again, at this, because again, 3 years have passed, year 1, 2, and 3. This is all in year 4 that we're talking about. So there's still 7 years left because they had a useful life of 10 years and they didn't change that. So we take the carrying amount after impairment, which is this $270,000. We divide it by the 7 years of useful life that there still is, and that gives us $38,571. That's rounded to the dollar. And that's how much depreciation they're going to recognize for the remaining 7 years of the asset's life, because there's no salvage value. So that's just the full depreciation all the way until 0 for this asset. So they're going to recognize that. Now, this is where you might have gotten caught up. This is also going to be included in year 4. So there is still depreciation in year 4, and there was the impairment loss. So the increase to accumulated depreciation was the impairment loss plus the depreciation after you figured out the impairment loss and how that affected the carrying amount. So $118,571 is the increase to accumulated depreciation. So what does that look like? That means that if it increased by that amount in year 4, it started at $150,000, but it ended at $268,571 of accumulated depreciation. So this was the increase. This is the ending accumulated depreciation. But that's how impairment losses affect depreciation and accumulated depreciation. We're actually going to do one more question in a slightly different format to hit that home. So let's go ahead and go to the next question to learn a little bit more about that. All right, here we are at question 5. What will be the carrying amount of the machinery at the end of year 6? So we have to calculate the carrying amount at the end of year 6. It's a little bit different than calculating the accumulated depreciation, right? Oakwood Industries purchased machinery for $700,000 with an estimated useful life of 10 years and no salvage value. At the beginning of year 6, the machinery had accumulated depreciation of $350,000. Due to market shifts, the company estimated that the machinery's undiscounted future cash flows were $200,000 and its fair value was determined to be $180,000. Oakwood Industries also revised the machinery's remaining useful life to 2 years after the impairment. So with all that, what is the carrying amount of the machinery at the end of year 6? So we have a lot of things we have to take into account. We have to figure out the impairment loss. We have, if there is one, right? We have to figure out how that's going to affect the carrying amount. We have to figure out what the accumulated depreciation is. We have to also figure out what the depreciation is from now on, because there's only 2 years left of useful life. So there's a lot to think about here, but I think we've talked about most of this enough in the previous 4 questions that you could probably give a good shot at this. So pause the video, do this on your own, try to do the calculations, try to apply what we've learned, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C. $90,000 is going to be the carrying amount at the end of year 6. So let's walk through this. First, of course, you have to figure out the carrying amount before they even considered impairment. We were given $350,000 of depreciation, and that makes sense. It had a 10-year useful life with no salvage value. 5 years have passed. 5 times 70,000, 350,000. So that makes sense why that's the carrying value going into year 6. Now we perform an impairment test in year 6. This carrying amount, $350,000, is greater than the undiscounted cash flows of $200,000. So this means that it's going to be impaired, but we don't subtract the $200,000. Remember, you don't subtract the undiscounted cash flows. That's only there to figure out if an impairment is needed. You subtract the determined fair value, which was given $180,000. So $350,000 less $180,000 means that there's an impairment loss of $170,000 to get down from $350,000 to $180,000. So that's the carrying amount as of right now. After the impairment loss, it's $180,000. Now that we know that, that's the carrying amount right now, before we've considered any of the current year depreciation. It also was stated that the useful life after the impairment is only 2 more years. So instead of another 5 years, it's only 2 more years. So we take the current carrying value, $180,000, divide it by 2, and that gives us $90,000 of depreciation that's going to be taken in year 6 and year 7, and then the asset is going to be at 0. So that means that the carrying value at the end of year 6 is $90,000, because it was $180,000 after the impairment and everything. And then by the end of year 6, you take the depreciation for year 6, and that gets you to, again, $90,000 as the carrying amount for this asset after the impairment. So that was 5 questions talking about impairment losses. We covered a lot. Before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice things that keep popping up. Maybe you've seen 2 or 3 or 4 questions trying to teach you how an impairment loss affects depreciation. Or maybe you've seen 3 or 4 questions trying to ask you how recovery works for impairment losses, depending on if it's an asset held for use or for disposal. Whatever the case may be, you're going to notice just by doing the questions, the things that kind of come to the surface that are obviously the most important. So you take a moment after or during your study session with the questions and you write down these pillar topics in your own words, kind of a summary of the most important things that you learned from the questions. And as you do this each day throughout the process, you will be building the most important topics that you need to know so that you know what's most important for test day. So with all that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just go through these. Again, these are kind of a summary of what we learned from the questions. First of all, for impairment testing, if the carrying amount of an asset exceeds its undiscounted future cash flows, so again, you're only comparing it to the undiscounted cash flows, the asset is considered impaired, and the impairment loss is the difference between the carrying amount and the fair value, and you'll most likely be given the fair value. So that's how you calculate the impairment loss. Accumulated depreciation and impairment, let's talk about that. When an asset is impaired, the impairment loss increases accumulated depreciation, effectively lowering the asset's carrying amount. And that makes sense. If you're trying to get an asset's carrying amount down to what the fair value should be, one side of the journal entry for that is going to be accumulated depreciation, because you're trying to decrease the carrying amount of the asset down to what it should be. And as far as figuring out the depreciation after impairment, once impairment is recognized, depreciation is recalculated based on the new carrying amount, salvage value, if there's any difference in salvage value or whatever that is, and also the remaining useful life. So whatever the remaining useful life is, whether that changed or not, you figure out the new depreciation going forward after the impairment loss. Now, as far as assets held for use and assets held for disposal, doing recovery of impairment losses, let's talk about the irreversibility for assets held for use. Impairment losses for assets held for use cannot be reversed, even if the fair value of the asset increases after the impairment has been recognized. So if you're still using the asset, it's not one that you're thinking of disposing. If the fair value goes up, you can't reverse any of that impairment loss. However, if you have an asset held for disposal, you can potentially reverse that impairment loss, but you can only reverse it up to the original carrying amount before the impairment was recognized. So, and that makes sense. You can't magically have an impairment recovery that puts you above where you were before, because that would mean that you're recovering more than your impairment loss was in the beginning. So you can't go past the original carrying amount before the impairment. And with all that, those are the pillar topics for this video. And that is the end of the video. But before you go, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. Make sure you sign up for that, because again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time. So again, make sure you go check that out. And after you go check that out, you'll probably want to learn more about our Pro course. Just remember that Superfast CPA Pro members will have access to the full 10-question versions of these 5-question videos when we post them in the members forum. So they're going to get more practice. They're going to get access to a lot of other resources as well. So again, if you like this and you like our other products, make sure you become a Superfast CPA Pro member to get access to all these awesome resources. With all that, I hope that you liked the video. If you did like it, make sure to leave a like and a comment on the YouTube video. I hope this was helpful, and I will see you in the next video.